Welcome, everybody. Good morning to Benzinga All Access, getting started here on a Friday morning. It is September 9th. We have a great list of companies that are all going to be presenting and getting started. A couple of news headlines that are moving markets and also everything interesting that happened yesterday. We want to talk about all of those, but to get things started, we want to play our All Access intro and get things kicked off. Let's go ahead and get it rolling. Excellent. Awesome. All right. We're going to keep things moving. A couple of items to clear through before we get to the news headlines of the day and then kick things off with our first company, StateHouse Holdings. Before we do that, a couple of things to go through. We want to talk first and foremost, of course, about the $100 giveaway we're going to be giving to one person who fills out the link with the contact form in the description or scans the QR code that is on the screen. One person out of the people who enters this. And again, I think each week we're only having 12 to 15 people register. So again, you still have a 1 in 12 to 1 in 15 shot, which are pretty good odds. So fill out that contact form. We'll select one person during the All Access show. We'll announce it during Benzinga Live in the next show, and we'll have one winner of the $100 giveaway. We also want to cover our sponsor, Ticker. We're very appreciative of Ticker and everything they do for All Access throughout the year, giving us the chance to interview these companies face-to-face with the executives and the CEOs that make these companies run. So we want to run the Ticker intro now, which is going to show you how to get involved with the company and start earning stock perks for the companies you own. Let's go ahead and run it.
What is Ticker? That's right, Ticker with 2 I's, just like you. Because it's for you, for investing, for stock perks, for connecting you to public companies who reward you as a shareholder, as a brand lover. That's why people can't stop tickering. Ticker, where investors discover shareholder perks and consumers become investors in the brands they love. Ticker. Start tickering today.
Perfect. All right, we're going to go ahead and move into the news headlines of the day with all of the house cleaning items out of the way. Let's go ahead and get started with the biggest news headlines that are going through the markets. Of course, Queen Elizabeth passed away yesterday at the age of 96, the longest reigning monarch in England's history. Obviously, tributes from all over the world coming in today. The social media is fully abuzz. And of course, it's going to be King Charles now who's taking over the throne, who is the oldest monarch that's ever taken over the throne in England. It's a huge headline. I think, obviously, it's something that everybody was not necessarily expecting, but the longest reigning monarch of all time in England's history. Huge headline when she passes away. So countries all over the world expressing their condolences. The White House lowering their flag to half-staff yesterday. Huge headline across the news. Queen Elizabeth passing away yesterday. So certainly remembering that for England today, but we also want to talk about some other things that are going on in the markets. The U.S. markets looking to end the week on a strong note. We don't have Aaron Bree with us to give us a market dissection, but it's looking like we have a couple of Fed speeches coming up at noon, so we're going to look for those to give us some direction on the markets. We do actually have another interview with Anne-Marie Band, the CEO of the Trading Book, coming up later today too. We love these interviews, which we usually publish early next week. We usually record them on Fridays to go over the week's news, but she's got some really interesting bullet points coming up for us about the Fed decision, about what's going on in the markets in terms of inflation, Jerome Powell still being addicted to this idea of combating that with whatever measures he needs necessary. So look ahead to that interview with Anne-Marie Band. We'll get some more dissection about what's going on in the markets. But as of right now, we've got a bounce. It looks like we're going to try and close off this week on a positive note, which I think we'd all be open to after what we've seen in the last couple of weeks. And the last item that we want to cover, football season is back with us. Last night, the Buffalo Bills annihilated the LA Rams. This is obviously very exciting because the LA Rams were the defending Super Bowl champion from last year. Very excited about this. I personally love the NFL. I couldn't wait to get on here and talk about the Bills. Josh Allen is actually my fantasy quarterback. Very excited about that. But they took down the defending Super Bowl champions last night. I think it was 31-13 or something like that. Huge opening win for the Bills. So the NFL is back. I know Aaron Bree is excited about this too. I know he's going to be talking about this every week. But those are the top headlines for what we have this morning. Again, a couple of things we want to call out before we go ahead and get things started with the first company. We want to remember Ticker, our sponsor. You can get involved with stock perks with that company for the companies you own. You'll get stock perks for those companies like Nike, like Starbucks, like Amazon, etc. All the companies you own stocks in, you can own stock perks with by getting involved with Ticker on their platform there. And of course, the $100 giveaway. We want to mention that one more time too. There's a contact link form in the description below in the YouTube video. You can fill that out or scan the QR code and fill it out there, and you're entered to win $100 at some point during Benzinga Live. So, a couple other things we want to cover before we get things rolling. We got some other big shows coming up today. Benzinga Live. Aaron Bree has some big interviews. I want to say one of the speakers is coming on from Nawara or Nakora, one of those two. But we're going to have some big speakers and some big interviews on BZ Live later today. And I think, correct me if I'm wrong, AT, but I believe we have Money Mitch on later today as well. He's going to be doing a couple of shows for us. So some exciting stuff. Good interviews. Want to make sure you tune in for all of those. We're considering doing some giveaways for during other shows at other points during the day. Haven't decided on that yet. But if we start getting those numbers up during All Access and getting some more participants in there, we may be bringing on some more giveaways during some shows later in the day. So look for all of those things ahead. But of course, looking at other headlines going on today, not a whole lot happening in the markets. Again, Aaron Bree not with us to give us a dissection. But before we get started with our first company, just looking across the headlines for today, again, the Fed obviously kind of running the show here for the most part. We've got a couple of speeches at 12. Not a whole lot in terms of other news. It just looks like the markets may be kind of getting ready to take a bounce. And just run over some of this fear and some of this angst we've seen in the markets. So again, look for that interview with Anne-Marie Band, CEO of thetradingbook.com. Whenever we bring her in on Fridays, she gives us the rundown of the week before, Monday through Thursday. All of the news events that are kind of affecting what's coming up, but gives us trade ideas too for what she's seeing in the week ahead, where she's going to short, where she's going to take long positions, how to play the plays that are going to keep moving ahead from what she already did this week, and then continue moving into the next week, where she's going to ride out her short positions, where she's going to stay in her longs, exit and entry points, and of course, how to navigate all of this with safety and being cautious too, because the markets are a place to use caution, of course. So all of that coming up soon. I think we're about ready to go ahead and get started with our first company and kick off All Access. Let's go ahead and bring him on. We're going to start with Ed Schmaltz, the CEO of StateHouse Holdings. Ed, welcome to All Access. How you doing?
Thanks very much, Michael. Good. How are you?
Great to have you here, Ed. Very excited to have you kick off All Access for us today. We've got a good discussion ahead of us. Let's go ahead and kick things off. Can you give us a profile of StateHouse Holdings and what the company does?
Sure. So StateHouse Holdings is one of the largest publicly traded cannabis companies in California. We've got 13 retail stores we operate in the state of California, one in Oregon. We've got a total of 9 brands, 230,000 square feet of greenhouse, putting out about 36,000 pounds of cannabis a year, and a manufacturing facility in the center of the state, serving those retail stores, as well as over 700 cannabis dispensaries across the state.
Fantastic. Okay, take us through, first of all, here. Can you talk about the regulations for cannabis in the state of California? Can you give us just the lay of the landscape of what that looks like right now?
So the regulatory environment in California is a tough one, but honestly, it's difficult in every state, and certainly in the provinces in California. We have a number of hoops to jump through, and they're really focused around public safety, right? And I think this is a key point of differentiation between the legal market that is tested and vetted, and highly controlled in terms of a series of steps you have to take, and the illicit market, where people are growing in the Sierra Nevada mountains and spraying DDT on the product and then delivering it, right to the customer who, you don't wash your weed. And so while the regulatory burdens are certainly there, I do think it provides a clear separation in safety between the legal market and the illicit market.
Understood. Okay, interesting. Now that we've got a background of where you guys are working and what that industry looks like, take us through the 4 companies that merged to actually create StateHouse. What's the background of why this came about? What were those 4 companies, and why is it so significant that they did that?
Sure. So this was quite a long time coming, as you can imagine, the complexity of putting 4 companies together in cannabis. And I guess let me start with the rationale for this. The first thing we thought of is the need for scale in this industry to be relevant, and then the need to be vertical, growing, manufacturing, and selling, to be efficient and to shield you from the ups and downs of any one particular area. And then we thought if we got those 2, we'd be able to attract capital, which indeed turned out to be the case. So just to sum up for the viewers, we've consolidated 4 companies four complementary businesses in California. They are Harborside, which was a Northern California retailer, and really the first brand in California cannabis. I think they sold the first legal weed in California in 2006. We brought in Urban Leaf, which was a dominant San Diego-based retailer, giving us a total of 13 stores in the state, as I mentioned earlier. We brought in Loudpack, which is the brand's the production and distribution operation, centrally located in California. And then Sublime, which brought its leading pre-roll brand Fuzzies, which added to our category leadership in one of the fastest growing segments in California, which is infused pre-rolls. And we put all those together. So operationally, we cover the entire state, as I mentioned, and we kind of have a Goldilocks selection of assets, meaning we have the right size of cultivation, manufacturing, and retail. We don't have too much of anything that might force us to make decisions to cover up for having too much or too little. And, you know, for me, with a background in retail, I really like having 13 retail stores. They can feed our brands with immediate data on consumer preferences and purchase patterns, while giving us a competitive advantage against other brands that don't have this data feed of customer purchase patterns. And the brands give us market share. And as more and more retail stores open in the state of California, that's a lot of shelf space that needs consistent and reliable brands that we provide. And then the vertical integration I mentioned earlier protects us against the ups and downs. And we expected to get improved gross margins when we put everything together. And I'm pleased to say we're really exceeding our expectations in that regard. The operational efficiencies were there and are actually exceeding our expectations.
Excellent. Okay, so we've got to break down these four companies. What I really want to know beyond that too is, and we'll talk about the land pack acquisition, everything else that you mentioned earlier. But what I really want to know is, when you're looking at strategy for newer companies that you either want to acquire or work with or partner with, is that still factoring into how you're running things, or has it kind of cleared up now that you've got these four companies coming together and creating StateHouse? Is that still a part of your strategy?
Well, it certainly is. It sort of has to be, right? You know, we're really focused on our retail business and our CPG business. And that's important to us. But we always have to have in the back of our mind, you know, what could come next, and you know, what's the strategic rationale? We have a clean platform to further consolidate the state of California. That absolutely is happening. We have a strong team and the infrastructure to be an acquirer of choice, where companies might say, that's a company I'd like to sell my company to because I like their vision, I like their team, and I think they're going to be not just a survivor, but one of the dominant companies in California. So we are looking for bolt-on acquisitions. Just to be clear, I don't want to solve another company's problems if they have tax issues or investor issues. We're looking for clean bolt-ons at retail in geographies where we don't currently compete, LA, Orange County, the North Bay, Sacramento, places like that, or brands with some leadership position that we can bolt on to our existing infrastructure and drive success there. So that's really important. And then the other thing I think we have to think about all the time is, you know, what's an exit plan? There's consolidation in the state of California, but there's consolidation nationally as well. And the California market is the largest cannabis market in the world, but it's sort of the last frontier for the MSOs. The MSOs have been waiting for a large, efficient operator in California that can take the risk out for them so they can step in and have an immediately accretive acquisition. So while that's not our plan, we're focused on just being a successful business in California. We do think that's a possible outcome. And because of that, we think we'll be even more attractive as an acquirer, because people will see that long-term possibility and say, hey, this company is going to be successful on its own. And then there's a good chance that some bigger company comes in and gobbles them up.
Got it. Okay, it makes a lot of sense. And that kind of leads me into exactly, you know, what I wanted to discuss next, which is when you're looking at these, you know, four companies coming in and creating StateHouse Holdings out of these four different entities, you would assume that there are a lot of redundancies and opportunity costs to kind of cut out that you guys were probably able to eliminate by creating one entity in StateHouse Holdings. How have you guys done that? Were there redundancies to cut out, and how much of an impact has it made so far?
Yeah, for sure, right? And as we approach this, I have three watchwords I talk about a lot at the company: focus, clarity, and execution. So let's focus on what matters. A wise man taught me once: first things first, second things never. Clarity around what we stand for as a brand and as a company, and what our brands stand for, and then execution. Get work done. And so we moved quickly to eliminate redundant operations, multiple manufacturing locations. We had 3, now we have 1. We reduced overhead, largely headcount, and this is brutal, but it's something you have to do. We have a responsibility to our shareholders to get efficient, and we did that. We reduced expenses by over 10 million by the middle of June, and we have another 10 million in the works. And our plan is to be one of the lowest SG&A to sales ratio companies in the cannabis industry. And I think we're going to get there. Our vertical structure allows us to achieve this. And we're making prudent investments in technology to help us manage a company and become operating efficient, very lean, and create cash flow in the very near term to attract investors and drive our share price.
Got it. And I like what you said. There was that first things first, second things never. Is that the phrase? I like that a lot. You guys have the priorities in line. It makes a lot of sense. And that kind of naturally leads to margin improvement, right? In what areas are you creating margin improvement? Where were the opportunities to do this? And how has the impact of your margins, if any, that you've improved been so far on StateHouse?
Sure. I do want to say one thing about first things first and second things never. The cannabis industry has been plagued by new shiny, right? There's new opportunities popping up all the time, and some of them have been legit, but a lot of them have been distractions. So I think that focus on our business and what we're doing is the path to success. So to your question on margin improvement, I mentioned earlier we're exceeding our expectations, and the vertical structure has allowed us to achieve mid-70s gross margin when selling our in-house products through our own retail stores. And, that's significant. And that puts us close to some of the limited license states where there's much less competition. So I'm proud of our team and what we've been able to achieve there. And I think this is a really strong competitive advantage for us in our own retail stores, is these gross margins that we're able to generate despite the rigorous competition in California. And then on our own retail stores, we've already improved our standard retail margins to nearly 60%, which is up significantly from the pre-merger operations. And that obviously is a big win for us as well. Our manufacturing facility continues to make improvements in efficiency. We've changed the layout to reduce travel time. We've adopted lean and 5S approaches. We've got much more efficient process engineering, and we have further automation coming to continue the movement to drive our costs down. We need to do this to maintain our competitive position in the state of California and to achieve the economies of scale that we expect. So that's a win for us.
Outstanding. Okay, let's stay on the topic of the financing side and the economic side of things. If you're looking at, ultimately the end goal of this, I think goes without saying, is to become a profitable company and attain that profit and ultimately grow your profit as an entity. When do you expect to become cash flow positive? Is there a date in mind for this? What's the roadmap look like to getting there? What can you tell us there?
Sure. Well, we've said that we will be positive EBITDA in 2023, and I can say we're working hard to beat that.
Awesome. Well, great. We're looking forward to seeing it. I'm sure you guys have plans in place there too. And in addition to that, there was a recent change to the company's share structure too. Can you give us any details on that side?
Yeah, we had 2 different classes of stock, single voting share and an MVS multiple voting share. And now we just have 1 class, common stock. And we want to make our stock more accessible, make it easy to buy, hold, and trade. Multiple classes of stock, I don't know, they always seem to me a little slippery. Who has preferences or who has more votes and why. We want to treat all our shareholders the same. So when we changed our name officially to StateHouse, we revised the Harborside ticker HBOR to STHZ on the CSE and the US OTC. So StateHouse, it trades under STHZ now with a single class of stock.
Got it. Okay, clear and concise. Let's start talking through some of your recent news too. Obviously, a couple of these things we've already mentioned. We've talked about Loudpack. We'll break into that a little bit more in a bit. But the second quarter results, the earnings results that you guys announced, take us through that at a high level. Any highlights in there that we're not going to talk about in depth that you want to mention and really put out there for us to pay attention to?
Well, the second quarter was really our first quarter as a combined entity, right? Recall the Harborside and Sublime transaction closed a year ago, last summer. And then that entity closed with Urban Leaf on March 1st. And then that entity closed with Loudpack on April 4th. So really the second quarter, April, May, June, was the first quarter where we were together. From my perspective, that was kind of a roll up your sleeve quarter, right? We were really getting our arms around the business. We were making those changes I referenced earlier, closing down or selling off infrastructure that we didn't need. We actually, through a white label agreement, moved on from the Urban Leaf manufacturing facility in January. So when I say we moved quickly, we moved very quickly to streamline the operations and to really get aligned on one core entity to achieve those efficiencies. So the second quarter to me was really a roll up your sleeves, get stuff done. Let's understand the assets we have. How are the wholesale brands doing? How are the retail stores doing? What's the combined SG&A and the cash burn level? And then we're working kind of taking that momentum into Q3 and Q4 in 2023 with the ongoing changes that we're making with those objectives to be strongly EBITDA positive in 2023 and working hard to achieve that even earlier. So I'm looking forward to Q3. I'm looking forward to Q4 as really opportunity. That's more the stage for us to stand up and show what it is we're capable of and the direction that we're going in. So I view Q3 as a roll up your sleeve and get stuff done. And investors should really focus on our expense line and on the EBITDA capabilities in Q3 and Q4.
Got it. Okay, and again, we talked about this a little bit already with Loudpack, but something that stood out to us that we want to detail out a little bit more. Urban Leaf and Loudpack were specifically mentioned in that Q2 earnings report. When you look ahead, when we're talking about profitability and looking for becoming cash flow positive, how are these companies going to affect what StateHouse is now? Is there any detail about how they're already impacting the bottom line, and what's some detail about why there are two names that were specifically mentioned there?
Yeah, so Urban Leaf store, and that was where I came from, right? I was the CEO of Urban Leaf. 8 retail stores in Southern California, most in the San Diego area, but also up Grover Beach and Seaside. Urban Leaf is a very interesting company because what they've done is achieved 40% of their sales come from the Urban Leaf brand. So that is a private label brand that nobody else has in the state of California. It's only available at Urban Leaf and now the combined Urban Leaf Harborside stores. So I think that's really a superpower of this combined entity. We have a brand with significant market share that is extremely good price value for the end consumer and results in strong margins for us. You think about department stores or grocery, right? Whole Foods has 365. Everyone has their private label brand. But we've had this for years. This is not a new thing, and with a significant market share. And so this is a key driver of margin for us. And in the rugged California market, we're not having to respond to the store down the street that might mark down a brand, and customers might go to that store for that brand because no one else has this brand. So I think that's a very powerful thing for us. Now, as we drive our private label brands across all of our stores, as a retailer, I really don't like being above 50% because I think that's an over-heavy concentration of private label brands. Customers want choice at the end of the day, and they want that sense of discovery of finding a new brand or something that they hadn't considered before. That's at the heart. That's what good retail is. So customer walks in, I'm going to get my $30 Urban Leaf eighth, and oh, what's that? I haven't seen that before. And they walk out with maybe more than they anticipated, but with a smile on their face because they're looking forward to trying this new product or this new brand that they've discovered. So I like being at 45 or 50% private label brands. to outside brands in the store for a dynamic retail experience. Now, Loudpack brings us some really strong brands, category leadership in a number of categories. Edibles, infused pre-rolls. Loudpack has Smokies, has King Roll and King Pen, Dime Bag, as well as the Loudpack brand. So, I like all these brands. And one thing we're doing that I think isn't yet widely understood in cannabis, but it addresses an increasing challenge, which is channel conflict. Brands and retailers competing with each other. We're taking two of our brands, Dime Bag and Loudpack, and we're not selling them at our own stores. I want retailers to not feel like I'm competing with them. I want them to feel like we're supporting them. So two of our brands are going to be available in retailers, and we're not going to see them in our own stores. So we're not competing with our retail customers that we supply, and they can feel like we're supporting them rather than having the same brand in our store down the street and being competitors. So Urban Leaf gives us retail strength in Southern California and a strong private label brand. Loudpack gives us 5 terrific brands with great market share growth possibilities.
Solid breakdown. Awesome. Okay, talk us through a little bit of the management side of the business, the team that you have running this. You had a recently appointed vice president of marketing. Talk us through the team that's running all of these things, especially with, I'm sure, all the moving parts that have gone on with 4 companies coming into StateHouse and making you what you are now. How does the management team factor into what you do on a day-to-day basis?
Well, the management team is sort of everything, right? I mean, you win with talent. I think we have a really strong management team with great experience outside of cannabis. But most importantly, I think the minimum amount of time anybody has in cannabis is 3 or 4 years. And this is important because while cannabis has a lot of similar elements to retail, CPG, what have you, it is fundamentally different. The culture is different. The operational cadence, the regulatory environment that you referenced at the beginning is different. So I think our team brings a wealth of experience from the industry. We're really working well together, and I'm excited to see what this team can do as we give them more opportunities to achieve. So we've got plenty of work ahead of us, but the team is hunkered down and executing, and that's the most important thing.
Awesome. Great. And then a macro look at your industry too as we start to close. Look at the cannabis industry a year from now, 2 years from now, 3 years from now. How do you see it progressing in terms of regulations, in terms of overall revenue growth, and StateHouse specifically, inside the next 36 months, growing in conjunction with the cannabis industry inside of it? How do you see that growth playing out? What does the company look like 3 years from now?
All right, I'm going to combine those. So I'm going to say, well, our plan is to be the dominant cannabis company in California. And I think we have the team and the asset base to get there. I don't anticipate any changes to state-by-state restrictions in that 3-year time frame, but I do think safe banking or something like it will pass, creating more liquidity, allowing a huge pool of U.S. capital to invest in cannabis. That'll lower our cost of capital and provide further support for our business model. As I think about our company, I see us having 25 or 30 stores covering the key markets in California. I view those stores as brand outposts where we can showcase our brands and provide home delivery in obviously where there's population density to our customers around that. I'm not trying to compete with the home delivery only businesses, but I want to leverage our customers coming in. I want to keep them happy, whether they want to order online and do a quick pickup, whether they want to come and have a slow retail shop, or whether they want to sit at home and place an order. I want them to earn their loyalty points with us, be comfortable with the brand selection, and give us all their business. And so that should result in us being an efficient operator, as I mentioned earlier, with a strong balance sheet and producing substantial cash flow. We're also looking at licensing operations, licensing our brands into other states. It's an asset-light model. And that I view that as a way to project our brands across the country without spending our own capital and preparing for eventual legalization. If you're going to ask me when that might occur, I think it's at least 10 years out, possibly more. And but having a brand in multiple states just allows us to have a leg up on the competition when those state borders eventually come down.
Excellent. Well, it's an exciting future to look forward to. And certainly for StateHouse, it's a lot of detail you've laid out for us. Really good stuff here. Ed Schmaltz, CEO of StateHouse Holdings. Thank you very much for being here on All Access.
Thank you. Appreciate your time.
It's a pleasure to have you here. Ed Schmaltz, CEO of StateHouse, moving right into our next presentation on time this morning. Moving ahead, and we're going to talk next to Tom Rogers, the executive chairman, and Lou Schwartz, the CEO of Engine Gaming and Media. We're going to bring them both on and get things started. Gentlemen, welcome. How are you?
Good. Thanks for having us.
Good morning.
It's a pleasure to have you both here. It's always a joy when we get two guests on. We get two different perspectives. We get to hear about both sides of the business and everything that you guys do in your day-to-day. So let's go ahead and get things started. Tom, I want you to kick us off here. Give us an overview of Engine Gaming and Media for those in the audience that haven't heard of you guys. What is the company all about?
Great. Well, two ways to think about us. One, what we do, and two, the metrics that define us. Probably the simplest way to think about what we do is we deal with the influential. We are both a programmatic advertising company and a digital marketing company. And when I say we deal with the influential, on the programmatic advertising side, we take very influential brands, think Newsweek, one of the biggest radio brands, Cumulus Radio, companies that don't have what's called programmatic advertising capability. That's a form of advertising where digital marketplaces exist to match a company's inventory based on data to find just the right audiences to target. And that's a specialized form of advertising that traditional, very influential brands don't necessarily have the in-house capability to provide. And we provide that for them. And that's one key area. We take influential brands and we perform that critical advertising function, the fastest growing part of the digital advertising marketplace, programmatic advertising, a big macro trend area. The other part of the equation where we deal with the influential is our digital marketing is centered around social influencer marketing. This is a form of marketing through so-called influencers, people who have followings on the web, who become key spokespeople for all kinds of brands and all kinds of marketing efforts. And there's a lot of science now that goes into how do you take those so-called influencers in the social media world and connect brands to the right ones with all the kind of metrics and data you need to have a meaningful marketing campaign. So that's the essence of our business. Now we do that through three separate units, one called Frankly Media, which is our programmatic advertising unit, one called Stream Hatchet, which is our gaming data analytics business that gives us some very unique and differentiated opportunity in this influencer space, but also serves the gaming industry more broadly. And a third unit called Sidekick, which deals specifically with influencer marketing in the social media world. So that's what we do. To define us more broadly in terms of some data points so people can get a sense of how we're doing as a company. We are growing top line very aggressively for our first 9 months of our fiscal year. We grew top line revenues in the high 30s% range. Two major sources of revenue. Advertising revenue, which grew at about 36% for the first 9 months of the year, so-called SaaS revenue, which is an element of our business that runs through all three of those units that grew at about 30% year over year for the first 9 months of the year. Our net income has improved dramatically for the first 9 months. It was about $1 million, and that compares to almost a $26 million net income loss the previous 9 months. So some major improvement net income wise. And we have reshaped the company very substantially. We were previously 6 business units with a lot of focus on B2C businesses. By curtailing those businesses and now focusing just on these 3 units, it has been part of an effort to reduce our overall expenses year over year by about $16 million when those expense reductions are fully in place to put us in a position to get much closer toward cash break even. And when we look at how we are doing based on our first 9 months and roughly a run rate revenue-wise of about 40 million a year, we are selling in terms of market cap at about a 0.25 revenue multiple. So you put all that together, a company that is performing very well, a company in high growth areas, a company that understands programmatic advertising and digital marketing in a very substantial, sophisticated way. And we are trading well below our peers at a 0.25 revenue multiple that makes us, in our view, highly undervalued.
Terrific. Okay, great breakdown. Now that we know what you guys are and what you do, I want to go through both of you guys respectively really quickly. Give us a top line overview of your role at the company. When you wake up every day, what are you looking to contribute as your respective roles of executive chairman and CEO? Lou, start us off. What do you look to do every single day at Engine Gaming? What's your role and what are you trying to accomplish for the company?
Well, thank you, and good morning, and thanks for having us. So I'm the Chief Executive Officer. I would say I'm the rudder for this business. I wake up every morning really thinking about how to sort of drive sort of growth, how to innovate, and how to differentiate sort of our products in this space. So my chief remit is obviously to drive sort of shareholder growth, but finding ways that we can influence our products in spaces where we have sort of unique differentiation and giving sort of a vision for the rest of the company so that they can align against that plan in order for us to drive long-term growth.
Got it. And then Tom, as executive chairman, take us through really quickly too what your day-to-day looks like. What are you looking to accomplish for the company?
Well, as Lou deals with a lot of the day-to-day operational issues, my background and career history is all about making company transformations. I was the first president of NBC Cable. I founded CNBC and MSNBC at a time NBC was only a broadcast company, and drove that transition to make it a force in the cable world. I was CEO of TiVo, which redefined the entire television viewing experience, not only in terms of creating an on-demand experience through the DVR, but taking the whole notion of streaming to the television. We were the first to take Netflix and Amazon and take them out of the computer and make them streaming services to the TV set. And I believe with the kind of macro trends that we are dealing with at Engine, that we have the ability not only to transform a company, but to be very much a part of industry transformations here in the digital advertising and digital marketing arena.
Absolutely. Okay, and from either of your perspectives, I want to understand a little bit about your industry in gaming, and I really want to talk about the influencer side of things. You mentioned it earlier. We'll break into that in a bit. But the last couple of years with COVID and the stay-at-home culture, working from home, and everything else that we've seen, do you feel that that's increased the opportunities for this industry with streaming, with entertainment, with e-gaming and everything else? Has that been an opportunity for this sector?
Bill, you want to take that?
Yeah. So listen, the pandemic, really sort of enabled us to accelerate some of the themes in this business. Having audiences and people in sort of stay-at-home environments enabled gaming sort of as a sector only to sort of accelerate. our position from a social influencer perspective is, in this digital first world, influencer really has fueled all areas of interest. Influencer marketing, has proven to be authentic. Consumers trust influencers, and the ability to reach targeted audiences through influencers has proven to be more cost effective, to convert when compared to alternatives like Google paid search or Facebook targeting. Listen, the reality is brands today that don't have first party data are having increased challenges reaching targeted audiences, especially given the privacy safe changes to Google and Apple's policy. Without cookies and other browser tracking data, brands are finding influencers and their followers to be a much more predictable way of finding audiences that share common interests and behavioral characteristics. And our end-to-end platform enables those brands of all shapes and sizes to discover influencers that map to their brand's objectives. They communicate with them, they can measure their effectiveness, and they can reconcile, commissions and payouts at scale. And we do this for brands like Nike, Lululemon, Logitech, Fanatic, and many large gaming publishers.
I think to just take some of the mystique out of the notion of influencers for people who don't really follow the digital marketing area, the notion of renting celebrities to be spokespeople for brands has been around since for forever. And television, through all kinds of commercials, has used that tactic a lot. What social media influencers are able to do is bring real authenticity and credibility to that connection between a brand and the followers of those people, because social influencers are being followed because people believe in them in some way, think what they have to say is important, are regularly connected to them on a day-to-day basis, and their views on all kinds of things. And so when those kinds of social media influencers are inserted into a digital marketing campaign, as Lou was saying, it is a way to target a message that can be much more effective than other forms of marketing. And that's why it's being adopted by brands big and small. And that's one of the differentiating things about us that I don't think is really understood. We not only deal with some of the big brands that Lou just mentioned, the Nikes and the Lululemons, but we have a particular expertise in the small, medium-sized business arena. Those SMB advertisers have become the huge underpinning of Facebook and Google type advertising. But those kind of businesses are also looking for an easy, automated path, self-service type path into the social influencer world. And we provide a particular expertise in being able to begin a social media influencer campaign for companies like that. We also differentiate ourselves by dealing with the two different worlds of social media influence. There are gaming platforms that people have heard of, like Twitch and Facebook gaming and YouTube gaming, where live streaming goes on, and gaming influencers are all over that world. And then you have the world of social media, of TikTok, of Instagram, and social media influencers there. We are a company that is able to provide data and analytics and all kinds of discovery tools for brands across both worlds. And that also gives us a particularly distinctive expertise as we go with this. So we have all of that wrapped up in the particular world of gaming, which has become by far the most important, fastest growing element of entertainment broadly, particularly when it comes to younger demographics. And to be able to wrap that big brand, SMB, live streaming, social media, all within a gaming expertise really differentiates us. Important to be able to participate in macro trends, but you got to distinguish yourself from the pack, and that's how we do it.
Got it. No, it makes a lot of sense. And then either one of us, Lou, I want to direct this to you too. Talk a little bit about Engine Gaming's media assets. What are the assets that you guys have that differentiate you from other people in the sector? Can you talk a little bit about that side of the business?
So we have several units, as Tom pointed out. We have our Frankly business, which is focused on programmatic advertising and media solutions. We have Stream Hatchet, which is focused on data analytics and insights within the live gaming streaming space, and we have Sidekick, right, which is our end-to-end influencer marketing platform. We don't own media properties per se. We represent publishers that own media properties, and we assist them in monetizing their digital ad inventory as effectively their digital agency of record. Our programmatic team enables publishers like Newsweek to monetize their digital inventory, whether it's video impressions that appear on their page or static advertising impressions. We're exclusively their digital programmatic partner. We sell all their ad inventory, and we do that at scale for many other broadcasters and publishers. We see over 1 billion ad impressions. So at scale, we're a valued service provider and partner for those publishers that we represent. But today, we don't have our own sort of media properties sort of per se.
The other part of the media equation that we are real authorities in is measuring on the gaming platforms what's going on, what games are hot, what's not, what is getting the most viewing audience. These live streaming gaming platforms like Twitch have several 100 million people around the globe that are gamers watching other gamers play. And you need a force to analyze all the data that goes into the way Nielsen does for television, to be a provider of data and analytics to all the key game publishers, be it EA or Activision or Tencent. And we are the authoritative source for being able to put all that together in very granular form so that the gaming industry is able to assess their own performance in that world. And that world is a vastly growing media one, where the number of viewers is something that is dwarfing almost any other form of entertainment today.
Got it. Okay, and then guys, as we draw close on time too, I want to ask another thing about just the unique challenges and also the opportunities of being positioned in an industry that you're in. With all the other sectors around you, what are some of the things that stand out to you about opportunities, but also challenges that you address every single day in your company? Is there anything that stands out to you above everything else?
Well, the biggest challenge we face is I don't think we're understood by the market. I think we started out when we listed on NASDAQ about 2 years ago as being very ambitious, going after 6 or 7 different business units. And I think people were having a hard time figuring out what were we? Were we just a conglomeration of multiple businesses that they couldn't find a focus? We are very focused now. Programmatic advertising, digital marketing in the influencer space. We have a great top line growth rate. We have brought expenses way down. We are now selling at a multiple way below what our peers are selling at. And our biggest challenge is getting that understood, getting this differentiation that we have relative to the others who play these macro trends that we're a part of. And I think if we can get that understood, this is a much more valuable company than it is today.
Makes a lot of sense. Well, we're looking forward to it. Lou, any closing thoughts from you as well as we come out of here? I know we covered a lot of ground and you guys did a great job dissecting it, but anything that you would point out that you want investors to keep an eye on moving ahead here?
Listen, I think the company is uniquely positioned, right, in the gaming space. Today we serve 6, 7 of the top largest game publishers in the world. And this is a large TAM. It's a $200 billion global, revenue market if you consider all the revenue for video gaming. 3 billion gamers around the world. We have unique insights. We have influencer marketing tools that enable game publishers to manage relationships with their most critical asset, which are influencers. The company has a real unique sort of opportunity to not only continue to serve this particular market, to differentiate sort of our offering within this particular market and continue to sort of grow along with the macro sort of trend that video game publishing is seeing. And this is not sort of a one sort of or 2 year sort of sprint. This is a market that's going to continue to grow, not only for the foreseeable future, but for the long term. And we're a valued partner in that equation.
Absolutely. Guys, it's been a pleasure having both of you with us this morning. Tom and Lou, thank you so much for joining.
Thank you.
Excellent. Tom Rogers, Executive Chairman, Lou Schwartz, the CEO of Engine Gaming and Media, trading on the NASDAQ as GAME Game. We're going to keep things moving into our next guest in our next presentation. We're going to go ahead and bring on Joe Corradino, the Chairman and CEO of PREIT. They're traded on the NYSE. Joe, thank you for joining us. How are you doing?
Thank you. Thanks for having us. Oh.
Pleasure to have you here. Good. Looks like we got that camera moving down to the right spot. We'll get you in the frame right down there.
There we go.
There it is. Looking good.
Thank
Joe,
you.
it's great to have you here this morning. Excited to chat with you. We want to kick things off as we usually do. Give us a profile of the company. What is PREIT? What is the company's mission? And what do you guys do?
Sure. PREIT is traded on the New York Stock Exchange as PEI. We are focused primarily in the mall space. I say the word primarily because our business has really morphed over the past years, and we're doing other property types on our properties, including residential, hotels, medical, dining, entertainment, and we've been really at the forefront of that, and out in front of really bringing in a myriad of uses into our properties. It's served us well as one looks at the performance. Our traffic is up over 2019. Our sales are up. We increased our occupancy in the past year over 5%, 480 basis points. So the story's a good one. We're concentrated in Philly and DC with the majority of our properties. And we've continued to benefit again from those premier markets, those high barrier to entry markets. And today, much of the work is focused on introducing residential, hotels, and other uses to the properties, and improving our balance sheet, obviously.
Got it. Okay, Joe, I want to give a little bit of knowledge to our audience, too. Can you give us a brief description, the breakdown of a REIT and how it differs from other publicly traded companies? What's the function of a REIT in our market?
Well, essentially, a REIT it's a real estate investment trust. It typically pays out the majority of its earnings in the form of dividends, although we're in a period now where we're precluded from doing that. And its tax structure, its federal tax structure is different. So in many respects, it's a way to invest in real estate, right? By buying stocks, right? When one thinks about a REIT, the thing to really think about is the quality of the assets, right? And we like to think we have high quality assets, again, in high barrier to entry markets. So buying a share or shares in PREIT or in a REIT is a way of investing in real estate and avoiding the direct acquisition that includes active management, leasing, et cetera, and it gives you the benefit of being a real estate investor.
Got it. Okay, now when you're talking about the assets of REITs, but specifically let's talk about PREIT here, are there certain types of properties or certain types of tenants or different kinds of real estate that are overperforming over others in today's market? Is everything pretty much in line, or are you seeing some that are standing out?
Well, I think that, look, there are always winners and losers in every business. We were proactive starting a number of years ago. We sold off 19 malls, essentially half of our portfolio, malls that were located in secondary and tertiary markets. And we also took back 19 department stores that were underperforming and have replaced them all. And so what remains with PREIT is high quality assets in quality markets in When we do have assets that are not in Philly and DC, they sit in military markets. We have the only mall in Jacksonville, North Carolina, the home of Camp Lejeune, one of the only malls in the Tidewater area at Patrick Henry, the major naval base in Newport News. So our properties are somewhat, pardon the pun, bulletproof, and continue to grow both sales traffic and NOI significantly.
Got it. Okay, moving ahead into the rest of the year here. Obviously, talking about the market is a loaded topic at any point, especially in today's market and everything we have going on with our economy and the inflation that we're looking at. Give us your predictions for Q4 as much as you can. Obviously, none of us have a crystal ball, but in Q4, do you see property values rising? Do you see them dropping? What do you see the overall market tone being as we head into the rest of 2022?
So when you look at Q4, you also have to look at, you have to look back to pre-COVID, right? I mean, our industry, the shopping mall industry, was probably hit as hard as industries like cruise ships and airlines and hotels. And we were shut down for 4 months. That really, moderated investor sentiment in our sector. And so we've been sort of proving ourselves again, and have had a really dramatic improvement coming out of COVID. But there's a lag in terms of cap rates. It's very interesting. There was a sale about 10 days ago of a mall in Santa Anita, California, and it sold at a sub-6 cap rate. Probably the most telling sale in our space. And I think it bodes well for the future of our industry. The fact that you're going to begin to, in spite of macro pressures, inflation, recession, gas prices, etc., you're going to begin to see the mall space sort of continue to come out of its the perception of the market and have an improving cap rate environment over Q4, and I believe even through 23.
Got it. Let's talk in more detail too, not only Q4, but the holiday season specifically. If we're looking a little bit more into the weeds here, do you feel that the holiday season is going to affect property values? Is it going to affect traffic flow or anything like that? Is the holiday season going to have any impact on what PREIT does?
So far, traffic's on target. We have traffic counters at our properties, and we keep very close track of that. It's on target. I think while there may be a slight reduction in traffic, one of the trends we saw coming out of COVID is people were making less shopping trips, but buying more on each trip. They're very focused shopping trips. And as a result, we've seen sales grow pretty significantly. And it really is driven by that, again, purposeful shopping visit. And I think we're going to see that again during the holidays. Plus, I would add to that in some respects, moderate price increases, inflation, is actually good for our industry because it drives sales. And you'll probably see somewhat less promotional environment. But I think coming through the holidays, you will see a reduction in traffic, but I don't necessarily think that that'll result in a reduction in sales. Many of the national sales organizations are predicting increases in sales over the holiday season.
Got it. Okay, now in today's current market climate too, have you seen any investor pullback in terms of interest of acquiring properties? Has there been any slowdown on that side of acquisitions and moving ahead with purchases?
Well, there's been very few acquisitions or trading in the mall space. That mall I pointed to in Santa Anita was one of the only properties that that's traded in a number of years. Other than very low quality assets, which really were, a step a step ahead of givebacks. And again, we got out in front of that trend, and through 2012 through 2020, sold 19 malls before COVID. So we're sort of over that hump, if you will. But there hasn't been a great deal of trades in our space.
Got it. Okay, looking ahead here too, let's talk a little bit just about the bigger picture with your Q2 earnings and what you guys released just not too long ago. But your Q2 earnings report, can you give us any more insights into the market that you saw there on a macro level, your investment specifically? You've talked about the malls that you divested in and everything else, but the Q2 earnings report, were there any other highlights there from a financial standpoint that you would want to point out and dissect?
I think we're pretty proud of the fact that we outperformed our sector from a Q2 performance perspective. Again, grew occupancy 480 bips, and saw significant growth in NOI. And the important thing, I think, is that two things are occurring in the space right now. One, there's significant demand for retail space, and that's really driving our business now. And part of it is bringing in international retailers. And those retailers are coming from Canada and Europe. I mean, it's interesting that when I talk about Philly and DC, Primark is an Irish retailer. They have 13 stores in America, and we have 2 of them. And we have a very, relatively small number of properties, call it 20 assets. And so we're seeing significant demand for space in our markets that's driving our earnings growth.
Got it. No, of course, very impressive, outperforming the sector. In essence, what we want to know more than anything is, if you talk about PREIT, moving ahead with investments and everything, of course, into the rest of the market, omnichannel, give us your take on that. Omnichannel retailers, companies like Amazon taking on a big presence over the last few years. Do you see that affecting physical, hard-based real estate assets in any way? Have you seen that happening already? And where do you see the future of that going with PREIT moving into the market?
So a couple of things. One is that, initially we were all, very nervous about online selling. It's certainly dramatically increased during COVID for obvious reasons. As one looks at it today, many of the online retailers, from Warby Parker to Bonobos to Purple and even Amazon, are looking at bricks and mortar presence. And I think the reasons for that are pretty simple. One, you can in essence have a stronger business model by doing same day delivery by pickup in store. And the 65% of the mall-based retailers, 65% of the mall-based retailers are now having pickup in store, right? So they're actually outperforming the delivery in compared to an Amazon or other online retailers, because you can have it in a matter of hours. And I think the real proof of that is we saw in the last quarter, for one of the first times, certainly in a long time, online retailing decreasing in their growth as opposed to brick and mortar retailing. And I think that again, with the stores opening, the online retailers beginning to open up brick and mortar stores, and I think the importance of the social interaction that we sort of was highlighted as a result of being cooped up for over a year in our homes due to COVID, has really brought people out to dine, to be entertained, to shop, and to commune with others. That online stores opening up, I think you'll continue to see brick and mortar prosper, and be part of an omni-channel experience as opposed to in competition with online selling.
Understood. Okay, and another macro look here too. Let's walk through your plan to address the Fed tightening their interest rate hike and their interest rate targets, tightening the balance sheet. Obviously, what's your plan to navigate this economic climate we're walking into with the inflation that we're facing? How is PREIT planning to address this as we move forward the rest of this year, but beyond that as well?
Well, we've paid off about $80 million in debt this year, and we'll continue to look to take advantage of raising capital through asset sales, land sales, to pay down debt to try and minimize our exposure to those rising interest rates.
Got it. Okay, it's a good plan moving forward. Now, anything else that you want to highlight for investors when you look at PREIT? Obviously, what we've talked about, the common theme throughout all of this, right, is that investing in real estate is obviously something you have access to through a REIT. If there's something that you were going to point out to a retail investor buying shares in physical real estate, what are some things that they should be watching for in the market to make their decisions about which properties to invest in, which shares to invest in, what things should stand out in their eyes?
I think the key is really understand the quality of the real estate. Right, it's key to understand that, because that will really flow through to performance. Quality assets will perform well and thrive through cycles. When cheap is cheap, if you will, assets in secondary, tertiary markets are properties that retailers and other possible tenants will turn away from in difficult markets. And then there's the advantage with quality assets of bringing in multiple uses that I talked about, residential and as well as hotels, etc. That opportunity is not as available in secondary and tertiary markets. It's the quality of the asset, quality of the location is a key piece of advice in making an investment in a REIT.
Got it. Okay, good general knowledge for PREIT specifically now as we take a last look out here as we start to close. For investors, and especially those watching All Access and listening to you kind of give the knowledge that you've given us, is there anything in PREIT that investors should be looking for? Any big moves you're planning to make in Q4? Anything we should have on our radar moving forward?
I think the key for PREIT right now is to focus on continuing to improve its balance sheet, and also to sort of deliver operational excellence. That's our goal. That's our plan. Watch for us, and you'll see it begin to execute as we have, and continue to improve our company.
Outstanding. Joe, it's been such a pleasure having you here this morning. Great insights on the market, and especially what PREIT is doing specifically. Always a pleasure to hear the perspectives from industry leaders that are doing what you guys are doing. Thank you for joining us on All Access.
Thank you so much. Appreciate the opportunity.
Great to have you here. Joe Corradino, the chairman and CEO of PREIT, traded on the New York Stock Exchange as PEI. Moving right into our next presentation with our next speaker, we're going to bring on Dennis Calvert, the CEO of BioLargo. Dennis, thanks for being here. How are you?
Hey, great to be here. Thank you.
Pleasure to have you, Dennis. Looking forward to speaking with you. Let's get things kicked off. Where are you coming to us from? What is BioLargo all about? Give us a profile of you and the company.
Well, our headquarters is in Westminster, California. That's North Orange County. We've got operations, though, in Edmonton and Tennessee and even Colorado. We've got a lot going on. BioLargo is all about innovation and solutions for some of the most difficult environmental challenges that face our planet. We always say we have an emphasis in clean water, clean air, and a cleaner earth. We've been inventing innovations for over 10 years. We're now watching the fruit of that investment bear out with first commercial adoptions and significant rise in revenue. The innovation cycle is still continuing at the company. So we always say, if you take a look about every 6 months, the company's morphing so quickly because of that innovation cycle. But really, the thing that's most important is we're being recognized in the marketplace for commercial clients as a solution provider par excellence. Okay, so things are really expanding because, frankly, we've got great talent here, super smart people that know how to solve problems for big clients with a great pedigree and a lot of history. And so we're now watching that sort of critical mass come to bear, and it's just an incredibly exciting time for BioLargo.
Outstanding. All right, well, excited to dig into all the things that are making it so exciting, but let's kick it off with one of the most important topics, PFAS. It's something that maybe not a lot of retail investors are familiar with, maybe not even a lot of the younger generation. Give us a breakdown of what PFAS is, why is it dangerous? More importantly, what is BioLargo doing to address it?
Sure. So, so PFAS, we have a portfolio of innovations. In fact, when you look at the company, you're going to see a diverse level, air, water, and earth. I mean, just like for sustainability, what have we missed, right? I mean, there's a lot going on here. But the good news is it's all science and engineering. That's sort of the weave that interfolds in all of these innovations. PFAS is widely considered one of the largest, probably most on target innovations that we have for widespread adoption now. And timing is everything, right? We got ahead of the curve there. So about 2.5 years ago, we started an innovation cycle to develop a system, a technique, a machine that can extract PFAS from water. Now, what's PFAS? That's per and polyfluoroalkyl substances. It's a mouthful. These are the chemistry. This is the chemistry that was used to create nonstick coatings for over 40 years, sold by industry and in famous brands like Teflon and Scotchgard and things that are in carpets and food packaging. And literally PFAS is now being detected literally everywhere. I mean, everywhere. Rain, the Arctic Circle and the polar ice caps and mother's breast milk, and on it goes. And of course, there was a movie, Dark Waters. If you haven't seen it, it's a great movie to really explain the situation. But, when you look at PFAS and the way it was just deployed for over 40 years, and now that it's a very small molecule designed to withstand the degradation of nature, it's designed to last forever. Okay. So that's a problem. When you have little bitty molecules that last forever and they accumulate, they can become very dangerous. So they've been linked to adverse health effects like cancer and birth defects. Okay. Litigation going on all over the world. So there's a mandate now. The Biden administration has dictated PFAS as one of the top agenda items right 2 days after taking office. Now that's translated into aggressive action by the EPA. In fact, just last week, the EPA made recommendations that they would designate all PFAS, not all PFAS, a couple of really dangerous molecules, to be hazmat, hazardous material. Okay, so what that does is it now positions that contaminant to be part of Superfund sites, trailing litigation, extraordinarily low testing limits. It has implications across so many industries that must now contend with a minute particle in the parts per trillion that are in soil and air and water. And the impact is so far reaching, it's just astonishing. So we have an innovation, and the innovation is a technique and a machine, part of a system that allows you to extract and selectively extract the PFAS molecule from a flow of water and isolate that molecule into a small membrane. So the simple version is we run it through an electric chamber that migrates the PFAS and binds it to the surface of a membrane and collects it, and it does it selectively. And that's very important because selective isolation, the ability to extract and isolate, allows you to become highly efficient. Instead of taking all the salts, instead of creating this massive waste stream, we have a value proposition that says we're 1/1000th the waste stream and a fraction of the cost of the conventional techniques that would take PFAS out. And we just got our first customer. That's about 2.5 years of work. And the first customer doing a full custom design on a really significant, large installation with an industrial client. And we've got 3 or 4 channel partners signed up, and we're just extraordinarily excited. Many people consider the PFAS market something like an $80 billion a year market. Now, everybody and their mother's competing in PFAS, so don't miss that. Every major engineering firm with commercial and industrial clients and municipal clients is in the PFAS business in some way. What we present to that marketplace is a technical innovation that is eco-friendly, a fraction of the cost, super low environmental impact, and has all these boxes that are checked to accommodate the regs that are now coming at extraordinarily low detection limits. And so we're in it to win it, and it's a very exciting moment for the company.
Absolutely. So you brought in the word hazmat earlier, and I feel like anytime you bring the word hazmat into something, it instantly sounds like an even bigger problem than you've already described, right? It certainly sounds like something that needs to be dealt with. Now, in your estimation, when you guys are coming in to solve a problem like this, you mentioned that everybody's getting into this, everybody's looking for a solution to the PFAS issue. In your estimation, how big is the market opportunity for addressing PFAS and fixing this issue that we have? Can you give any kind of ballpark number there?
Yeah, well, the market, the experts tell us that the market's probably an $80 billion a year market. And we have anecdotal evidence where we're witnessing the sort of the flurry that's occurring in activity. And so let me describe that because it'll help investors and also everyone kind of understand the way it works. municipal clients are largely elected. They spend public funds. They have a public accountability. And if you think about that for a minute, that's drinking water usually. It's also waste stream, wastewater. But in that field, they have a duty to protect, and they have to move quick. So what happens is when PFAS first started a flurry, there was some pretty rapid movement to use old technology to try and extract and move some of these contaminants out of drinking water. So what they did first is they turned off the well. The second thing is then they spec'd out the best available technology at the time, which is probably carbon or anion exchange resins, to use them as an extraction technique to try and take them out of the water, which will work, right? At some level, it works. What they didn't anticipate was that the level that was going to be required is so extraordinarily low that it's going to render most of those installations obsolete. What they also didn't anticipate, which we've been talking about for years, is that the EPA set out a guideline, a roadmap, in which they predicted that it would become a hazmat. Now, hazmat designation raises the bar for everyone, and it raises the bar for performance and for cost and for sensitivity and disposal and destruction and all the things that are going to go on with, handling a hazmat material. So what it's done is it's made the market even bigger, because what happens is if they lower the detection limits to 1 or 2 or 3 or 4 parts per trillion, it means that the scope of its impact across industry is expanded so dramatically to minute concentrations of the contaminant, meaning no one's left untouched. Okay. It's a huge situation. And the thing about BioLargo is, we've got a group of professional scientists and engineers and people that have been doing their craft for 20 and 30 years. And because of that extraordinary experience combined with innovation, we have an advantage. We know what and how to do in a way that most people are still learning. I mean, we've just got a team of people that have been doing it for years at the highest level of industry and government. So now with that innovation, we can enter the marketplace with credibility, critical mass, a great environmental solution, a low-cost solution, and really provide that sort of turnkey solution attitude. And that's what we're doing. And so I think we're just seeing, the surface is just getting scratched. And if you haven't looked at, PFAS, just do an internet search. It's going to astound you. And if you have time again, I'm going to say it again, watch the movie Dark Waters. It'll tell you all you need to know. But for BioLargo, it means that we're at the center of this incredible storm with a significant competitive advantage that we believe will continue to expand, not diminish. We see all sorts of innovations going on destruction techniques, and our attitude really, and we think it's strategic, and that is the first thing to do is to become the most efficient collector. The most efficient collector, because destruction will be governed by regulatory oversight in such a dramatic way that it makes future regulatory opinions gatekeepers for your innovation. So what we decided to do is focus on the extraction first. We're expert in destruction. We have many techniques that we can deploy. There's also great innovation going on in the field of destruction. And from our perspective, if you can be the most efficient collector, you can use any technique for destruction. The thing is to get it out of the water and do it fast, because it's harmful to the world and to people. Remember, it's really all about the people. Having these contaminants that are persistent in the environment with these linked to all these adverse effects is just not cool. It doesn't work. You have to take action. And so I think it's getting bigger. How's that?
I think that's about as big as it gets. I think you broke down the opportunity and why it's so important to address it too. That's certainly a huge market opportunity, but a huge problem as well. And one of the things that we always appreciate on All Access too is when we bring on a company that has a market opportunity in something that's an issue because they're solving the issue. I really think it's the best of both worlds. So great outline there.
Right on.
Knowing that and moving ahead with PFAS, I want to also talk about one of the other things you guys are working on. It's a product called, and I want to make sure I get this word right.
Poof.
It's called Poof. Yes, Poof. Yes, we want to talk about Poof. There's been $100,000 of sales in this pet odor product called Poof recently. Take us through Poof, why it's so important, and why the product matters.
No, that product's doing almost 100,000 a day.
More than that, okay.
So let's make sure we get it right. So first of all, Poof is a brand, and it utilizes the technology that was developed by BioLargo. So we're a supply chain partner to the company that's launched that product. So make sure we're clear. That company's called Ikigai, Ikigai, Ikigai. Look them up. Anyway, they've produced an infomercial. They're experts in national branding, and they are expert, by the way. Their specialty is the art of the creation of content that makes such a compelling argument that people want to buy the product. They're just great marketeers and communicators to explain value propositions in a way that people are compelled. It's awesome. So if you haven't seen the infomercial, you will. All right. So I'm going to say, and look for poof. It's like poof. And it's an aggressive approach, and it's working. And it's working so well that they've announced, Ikigai announced that they expect to be on the shelves in Walmart in October. Give them some grace. October sounds like the perfect date. So we'll see. We're supporting them, of course, on the supply chain. The business deal we did is quite great for everyone. It allowed them to really secure the exclusive rights to use our chemistry in the pet odor control category. Poof is a pet product focused on pet odors. And the thing that's unusual is it's so safe and so gentle, it actually dismantles the odor compounds so they don't come back. So that's complete odor elimination. The second feature, of course, is safety. This is such a gentle, safe product, safe for the environment, safe for people, safe for your pet, right? That it's actually safe to use on the pet. And so it's an extraordinary advancement in the state of the quote art of managing your pet and pet odors, things like pee on the carpets, right? It's so basic. And if anybody's had a pet, you know what those odors are like, and eyes and ears and skin folds on bulldogs and all of that, right? It's just an astonishing. Look for the infomercial. It's now on national networks on a constant basis. They're up to about close to 100,000 a day. Their stated mission is to get to about 100 million in annualized sales, a run rate, as soon as possible, and then look to sell the brand to a national brand, one of the majors, right? One of the majors. So why is that good? Well, we participate as a supply chain partner. We get a small royalty on sales for the innovation itself, and then we participate in the exit at 20%. So we believe that they are and will continue to be highly successful. They are executing with precision. And on exit, you know, their target is going to be to look for something like $300 to $700 million exit, at which we would participate at 20%. Okay, now that means a check. And we stand down on the odor control for the pet industry. The thing to remember about that is within our portfolio, we own the technology. We are commercial and industrial spaces now, and landfills and transfer stations and some of the stinkiest places in the world, all over the country, including international. The technology has application across many, many different categories. Okay, and this is a very narrow focus on a specific brand called Poof, P-O-O-P-H, focus on pet odor control. It's just an absolute winner. And the other thing I want to point out is it's a validation of our business model. You know, we since inception, over 10 years, it's almost 15 years. When we started the business, we said we're going to invent, we're going to find first commercial adoption, we're going to make a deal with distribution so we can see wide mass distribution of these assets find their way into the marketplace. This is the perfect example of how innovation translates to an international massive opportunity when all the things come together, which is what? Well, technology, proof of claim, safety, experience, manufacturing techniques, patents, processes, right? Tools that make it go. And then with professional branders with this extraordinary talent to create a national brand in the most efficient way. This launched only in December. So you're talking about, 9 months achieving an incredible run rate. And we think it's just going to continue to expand. And so we're very excited and proud of our relationship. And as we say, we love these people. They're really good for BioLargo. And likewise, this has created an enormous opportunity for their team. So we're pretty excited on the win-win.
That's great to hear. Yeah, something like that is always an incredible success story. And also, I think this plays into when you're looking at your second quarter results, you guys saw a revenue increase of 185%. I'm sure Poof was a big part of that, of course, but other revenue drivers that have driven you guys to this kind of increase in your second quarter, what other products do you have in the pipeline? What other parts of the business are performing well? What else has led to this kind of significant revenue increase?
Yeah, so that's one of the beauties in the company, I think. I mean, we believe that the diversity has created an expansive opportunity. When you're talking about innovation, the thing that everyone struggles with is the adoption cycle. there's this, they call it the valley of death, right? I mean, how do you get over the valley of death? The literature's replete with strategy on being an innovator and getting over that adoption, that moment at which everybody sort of now recognizes it works. They're not afraid. They know you're not going to hurt anyone. It's safe. You're going to show up. You're not going to go out of business. All these things that really have to come together to allow for mass industry to adopt an innovation. That's the challenge. Okay. That's the challenge. So in our portfolio, the thing that's beautiful about the business is because of our investor support, we've managed to innovate for over a decade, which means we have about 7 technologies and more coming. I mean, just understand, more coming, because it's the nature of our business as an innovator solution provider. The way we say it is, if we don't have a solution in our portfolio for a client, we know how to get it. And if we can't find it from someone else, we know how to invent it. So that's extraordinary. Imagine sitting in front of an industrial client and saying, I don't have it, but I know how to make it for you. And so that level of sort of custom attention to some of these big problems allows us to go in as a solution provider under an environmental engineering role and be compensated to really walk with a client to precisely define a target, focus on the target, the time, budget, and the outcome, work with the client to achieve optimized results. That's extraordinary. And if you can do that consistently, which we're doing that consistently, you have a business that is desirable, right, in the marketplace. So the diversity is amazing, right? So engineering service is a big part of that, where we're actually being compensated to work with clients to solve problems. An example is we got this relationship, we got 2 relationships. One is, we got multiple, but really big ones. One is this project with Ultrasafe Nuclear. It started out as about a $500,000 engagement, and it's already expanding rapidly, because what they've recognized is that we understand what they need to do as an innovator, and we become part of the design team outsourced with this company. Well, that's awesome. I mean, that's a great example of where our diversity allows for economic opportunity to drive shareholder value in a significant way. Another one is we received a contract as the EPC, engineer, procure, and construct partner for a developer on a waste to energy project in Latin America. You say, what the heck, right? Well, our team has been doing waste energy and incineration and building power plants, over their 30-year career with extraordinary success and a pedigree. Plus our role in waste management. I mean, we're already under contract with all the national and international waste management companies. We've been working in that business now for about 7 or 8 years. Our team members have extraordinary experience. So we are credible. We are credible to take on those assignments. That project is a multi-phase project. The design phase is first phase, the feasibility, which is basically creating economic profile for the developer to make the economic decisions to finance the goal. If it goes to full project, it'll be the largest waste energy conversion project in the world. Number 1. I mean, just understand the scope. The design phase alone, by the time that goes to multi-phase, is probably over $50 million worth of design. And it'll take a small army to pull it off. You're talking about a massive installation of an excess of 250 megawatts. So again, our small company has the knowledge, the talent to come alongside an owner operator and say to that developer, let's go with you to hit the target precisely, make sure that you're on the cutting edge of innovation, that you're in compliance with environmental, that you built it for the long haul, that you've complied with all the local regs and all the tools that actually make it feasible, right? And that, again, a very diverse approach, but really significant. And of course, what it's going to do is put a lot of demand on our staff. I mean, we got to grow. We're going to have to add staff to staff up, and that's always a trick. Our profile really is to staff up as we go, not before. And so as revenues climb, we'll staff up so that we can continue to maintain some level of profitability as we're doing now. We've got 2 profitable operating units. So now with the growth now intact at the company, there's a significant backlog of projects. We can look forward and say, we can see the moment of positive cash flow and ultimately profitability in sights for this company. And so that's extraordinarily exciting, especially with the long development and R&D cycle. Last year we spent about $1.5 million in R&D, and of course we maintain a corporate office and all the reporting required for a public company in an excellent way, right? We've done it in a most excellent way, fully accountable. and diligent and always timely. And so that's a level of discipline that we've maintained, we've financed, and of course is now going to expand dramatically. So we think that the future for these multiple we call them catalysts, is dramatic. And then I'll just mention one more. In the portfolio, we've got this relationship, for example, with Garrett Callahan. Garrett Callahan is the largest privately held water company in North America. And so about 2.5 years ago, we went into a project with them and said, essentially, they had an idea. We said, they said to us, if you'll make it, we'll sell it. And I promise it's that simple. We'll make it, they'll sell it. So we're in the selling cycle now. We've developed a process for extracting minerals and maintaining bacteria for water cooling tower recycling. That's a big deal. If you look at industry, water cooling towers, heat exchangers are everywhere. And so we now have an advanced modular technique and a design to help people really manage that water flow in the most optimized recycle way. We have not landed our first customer yet, but we will. And when it goes, the way it'll go is real simple. It'll be 1, then it'll be 3, and then it'll be 12, and then it'll be 50. Because we're in partnership with the largest privately held water company in North America with an innovation that absolutely works and is ready to go to market. So again, think about that. We've got these major catalysts that we're focused on. And at the same time, we've got this organic and partnership growth bubbling up around the company. I think we've just scratched the surface in terms of our near-term and long-term future. And this is really the breakout year. So pretty cool.
Very exciting. The partnerships, the products, the progress so far, the revenue growth, Dennis, all very exciting. It sounds like you guys have the vision and the team to pull it off. And clearly, there's a lot more to come here. Very excited to keep watching this happen. Thank you so much for joining us.
Hey, great being here. Keep up the good work. Thanks.
Thank you, Dennis. Dennis Calvert, CEO of BioLargo, bringing him on there, running just a little over time. So we're going to move right into our next presentation. Zarko Miselja, the CTO and Director of RecycLiCo. Zarko, thank you for joining us.
Thanks for having me.
Pleasure to have you here, Zarko. We had the pleasure of having you on actually just a couple of weeks ago, so it's nice to have you back on so soon. Get to reintroduce you to the audience. Start off just a little bit by giving us the background of RecycLiCo, formerly known as American Manganese. Give us the story there and tell us about what RecycLiCo does.
Yeah, we're transitioning to the name Recyclable Battery Materials. Long history with the company as American Manganese, but our focus is on the recycling and upcycling of lithium-ion battery waste. So I know we normally just hear about recycling, and I really want to emphasize the word upcycling because it's with our patented technology and processing techniques that we're able to actually create higher value out of these products. So what does higher value mean? Just that instead of selling a product or having a product that's worth maybe 2x, it has a much higher premium, and it actually reaches more of the supply chain, cuts out more parts, and we have a product that can actually be more directly integrated into lithium-ion battery remanufacturing.
Got it. Okay, we've got the background. Zarko, talk a little bit about who your clients are at RecycLiCo. Who do you guys serve, and what does your market look like?
Yeah, so we've been focusing on developing this patented technology since 2016, and we've been growing from the lab scale, and it's with that it takes time as we're scaling advanced and I guess new technology, right? So you need to scale from smaller beaker testing to now what we have going on at a demonstration plant, and this is still not at a revenue generating stage or a commercial stage, but we are working with potential partners on testing their products, evaluating our process, doing their technical due diligence, looking at our products, testing it in the remanufacturing of lithium-ion batteries. So it's a lot of that back and forth with these companies, and those would be chemical companies that are working in the space of making the actual chemical products that go into the lithium-ion batteries, like cathode materials, so precursor cathode materials, lithium, so the chemical companies, lithium-ion battery manufacturers, electric vehicle manufacturers. There's different lithium miners. So it really spans across this whole supply chain because as recycling is a certainty. Like, we're going to have waste lithium-ion batteries. Every time I tell somebody this is the business we're in, they always wonder, I always wondered what was going to happen with all of these electric vehicle batteries. So so many companies are interested in how can we get involved in recycling? How can we get the the most advanced technology to recycle all of these materials like lithium, nickel, manganese, and cobalt, and reintroduce them back into our own supply chains? Because think of it from an electric vehicle manufacturer. Before, a vehicle manufacturer would just think, making cars, buying all their components from others. But now you're seeing so much more focus in downstream and upstream in their supply chain, trying to secure those supplies that are so critical to their growth. Because like a mining operation, if you need lithium or cobalt or nickel for future batteries, you're constrained right now. Mines don't come up in a year or two. This takes 5 to 10 years to even bring one up into production, and the demand is here now. So that gap between the materials we need for batteries versus the supply that there is a huge gap, and it is continuing to grow. And recycling is one of those that can really reduce that reliance on mining and supplement a company's internal supply chain.
Absolutely. And Zarko, I know we've got your deck pulled up here for RecycLiCo too. We can pull that up and start sharing some slides, anything you want to highlight anytime now or later. So we can get that up and ready. If you want to start looking through it now.
Yeah. If you actually want to go to page 11, one thing I really want to highlight when we think about recycling, right, is you have like those cylindrical cells, and they can make up like a full module, and then they're all stacked together, and those modules will make up like a battery pack, and that'll go into pretty much kind of that skateboard platform into an electric vehicle. But now when that electric vehicle goes and goes through its life, and now it's considered an end-of-life battery, and that battery needs to be collected, it needs to be discharged, it needs to be mechanically shredded and broken down into what will be a black mass. So that whole physical side of things is really what I call stage one. There's a lot out there right now and that's called recycling as well, right? The companies will call that recycling, where they're taking the battery, mechanically shredding it, separating out different materials like through magnetic separation, and then they're producing the black mass. And that's classified as recycling. But then there's also a stage two, because this black mass product that we know so well in the industry, that has lithium, nickel, manganese, cobalt, graphite, has some other impurities in there as well. And it's a valuable material, but you can't do anything with that material. It's almost like a mined concentrate. You need to actually now extract the value out of that. And that's really where we define recycling now, and that's really where we come in. And so it's this refining stage, which I think there's a big knowledge gap in processing capability and even commercial sizes right now. This is all still coming to market and scaling. So what we see with like a lot of competing technologies is that they'll take this black mass and just break it down into individual products. We'll think about, we need nickel, we need cobalt, manganese, right? That's all broken down into this kind of individual piles. And then to make that battery material that you need to go back into a lithium ion battery, you essentially need to take these materials, these individual materials, and put them back together. And so our logic was, why break it apart to only put it back? And this is where upcycling really comes in. We go from that black mass and go directly into that high value material. This reduces processing steps. This reduces chemical consumption. So obviously, I know last time I shared on our eco-friendliness and how we did a full environmental study on our process and showed very positive results compared to these competing. But yeah, just the economics, the environmental aspect of it creates more of a direct approach, and that's creating this precursor cathode active material and different lithium chemicals like lithium hydroxide, and this is what enables more of that actual circular economy, right? The circular solution, by being able to reuse these materials. So not just making black mass that's not usable, but actually taking that black mass and refining into something usable. And then the other slide I'd like you to go on is 15. If you could. Yeah. So with slide 15 here, kind of where I've X'd out these different steps is the traditional supply chain. If we look at how are we going to get these materials for our future lithium-ion batteries for cars and portable electronics, we think right away of mining, and that's going to go through different processing techniques. And then finally, you're going to get into these high-value battery materials that can go back into the manufacturing process. So our business model is more of this integrated approach, actually taking our technology and integrating it with leaders in the industry who have the waste. Because unlike a mining operation, we're not sitting on our resource where nobody can really get at that, because that's our claim of land, and we're going to mine this material and we're going to process it. In recycling, it's a lot different, because the ones who dictate the supply and who's going to recycle that supply are the EV manufacturers, the battery manufacturers. And long term, it really intuitively only makes sense to us that these companies, to be able to lock in their supply chain and reduce their reliance on mining and lower their own environmental impact, is that they're going to actually recycle it themselves, because they're going to need this material anyways. Instead of buying it from mining operations, they can take the waste, their old electric vehicle batteries, which we're seeing more legislation put the responsibility on the producer. So it really will be their responsibility to collect their old electric vehicle batteries, or even for battery manufacturers. During the battery manufacturing process, you're producing a lot of scrap material from just being off spec. It doesn't meet certain quality control standards. And then that material can also be recycled. And then this is an opportunity where you can bring in more of like a patented and advanced technology like ours in-house or co-located nearby, where that waste can be diverted, processed, refined, and then sent back for more remanufacturing. And that's how we truly envision this closed loop, right? Being an independent battery recycling facility where you're building more of like a central, one large facility and looking to buy supply from everybody, it kind of runs this risk and puts you at risk of competition with many others on where the supply is going to come from, because you're going to need to actually operate your plant at full capacity, where we really look at that backdoor approach and being integrated alongside these leaders who are actually dictating where this material goes.
Yeah. Terrific. Okay, yeah, and as you walk through all this, I don't know if there are other slides you want to share too, but there's somebody in our chat that was talking about you guys having the closed loop, like you just mentioned, the environmentally clean system being the best system out there yet for upcycling, doing what you're doing. Take us through any competitors in the space. Is there anybody else doing what RecycLiCo is doing? Is there anybody else creating this closed loop, and anybody else that you guys are standing out from in terms of the way you're doing it?
Yeah, so actually, maybe we can even put up to slide 12 for reference. I mean, it gets a little more technical, but when we look at competitors and like the different processes, right? There's two sides when I talk about competitors, right? And I think everybody's out there trying to do their best for the environment. Obviously, we're going to have a massive waste problem, and we're going to need to deal with a lot of waste batteries. So competition is always welcome, right? But when I look at some of the competing and more conventional recycling processes, there's, it goes, what I believe is a lot of inefficient steps of leaching steps, and then there's multiple steps of extracting those materials. Like I mentioned, like you'll see at the bottom, there's like an individual extraction of these materials. So you're going through all of these multiple steps with a lot of chemical consumption, a lot of waste production, and you're producing more of like an intermediate product that still needs to be further refined. Where I see like ours in the top of the slide, we have our patented leach process, and then from there we actually go from a direct production of that high value product. So less steps, higher value product versus more steps, lower value product. And then we also are able to regenerate a lot of the process reagents we use, also benefiting our economics. And then that's on the technology side. But then when I look from like competitors, I think our business model really stands out because a lot of competitors are building, like I mentioned, those large independent facilities where now they're going to be on the hook for trying to, get contracts, try and get waste batteries from whether it's portable electronics or whether it's from one EV manufacturer, another EV manufacturer, just as much as they can to process these materials. Meanwhile, I think there's multiple companies in this space who are also trying to do the same thing. Where our outlook is that the Teslas of the world, Volkswagens of the world, the big battery manufacturers, they're actually, my belief long term is that they're actually going to start doing this themselves because this really isn't a waste material. This is a high value resource that they could be recovering themselves. So why hand that off elsewhere?
Got it. Okay, makes a lot of sense. You broke that down really, really cleanly for us. I would encourage, of course, anybody that's looking at this too, to go to the RecycLiCo presentation homepage too that you guys have there. There's some really impressive numbers and a really clean breakdown of what you guys are doing with this upcycling and how your entire closed loop works. But I want to walk through a couple of the numbers that you have listed there. A couple of them, you mentioned the material, the cathode active materials and the battery cells on that page there. Give us a breakdown of those numbers' significance. There's some enormous numbers of how many cathode battery cells there's going to be. Can you talk about how this translates to the importance of what you guys are doing? When you look at these numbers of waste, as you've already talked about, why is it so important that you continue doing what you're doing when you look at our future? And like you said, how many batteries are already going to be recycled? Why is what you're doing so important, and why do those numbers matter so much?
Yeah, well, yeah, two parts to that. Really, when you look at the expected growth of electric vehicle demand, and electric vehicle demand is really, I think, like a major part of this because the batteries are so large as well. But you still have laptops, iPhones. We have a lot of electronics that are going to need batteries as well. But when you look at that growth, and the legislation coming out, like in California, where they're banning the sale of internal combustion engines. I really forget the date. There is going to be. That tipping point is already really past for electric vehicles. It's more that future to me is really secured. But then when we look at the numbers and where are all these materials coming from? So where's the mined material, the processing, the refining, the manufacturing? Where's all that coming from? And over 50% is a lot more than that is coming from China, and that becomes a really political topic as well, because we become so reliant on our future green growth on different countries, right? And that's slowly changing as we talked about last time when I was on All Access with the Inflation Reduction Act and that encouragement of a domestic supply of materials. But then when you also look at those numbers and you do the math and you break down, okay, well, if we're going to have 50 million electric vehicles, and then you make an assumption like how large is that battery pack, and then you just keep working backwards, and you realize, okay, how much lithium, nickel, manganese, and cobalt we're going to do, and the math doesn't add up with what we have in production right now, in terms of the lithium, nickel, manganese, cobalt, right? We even mines are being announced now, and our very large deposits will take time. So recycling, of course, is critical at this point. And where actually one point I also want to touch on is where's the majority of the recycling going to come from? I know we always get this question, and saying, well, electric vehicles are just starting to come out now. It's going to be still 10, 12, 15 plus years until we really need to recycle them. But we really took a step back and looked at, okay, where would the supply be now? And where the majority of the supply is really now is at the battery manufacturing facilities, because the demand for electric vehicles is here now, and so you need to make the batteries for those electric vehicles. But making those batteries is not as easy as one would think. You need to have things very specifically engineered. It cannot be a faulty product, as we've seen in the past with different battery explosions and phone fires. This is a very sensitive operation. So what the battery manufacturer ends up having is a lot of scrap material that needs to be disposed of, and right now more so treated as waste. But that material has all of those valuable material, like the metals, like lithium, nickel, manganese, cobalt, aluminum, copper, graphite. Like that's still all on there, and that can be recovered right now. And I even saw from a report, Benchmark Mineral Intelligence, I believe it was by 2025, 78% they estimate 78% of the recycled content will come from the battery production scrap. So it's not even talking about the electric vehicle supply right now. Maybe you'll have a few crashed EVs or some failed R&D testing, but a lot of it is coming right now from this run up. So recycling is needed now, and it's not something we should be thinking about later. Like you need to build these facilities now. Material can be recycled now, and that's primarily a focus on the battery manufacturing side first.
Outstanding. Zarko, the technical discussion has been really, really enjoyable. You clearly painted the picture why we need this now, and the upcycling process you guys have, very impressive. I know we've had a couple of people in our chat mentioning how impressive the closed loop system is and why this is the way of the future. So very exciting to see the path forward. Thank you so much for breaking it down for us and joining us again here on Benzinga All Access.
Yeah, always like to be on the show. Thank you for having me, and looking forward to future ones.
It's our pleasure. Zarko Miselja, the CTO and director of RecycLiCo, also known as American Manganese, formerly known as American Manganese, joining us there to talk us through upcycling and everything they're working on. That is going to wrap it for Benzinga All Access today. That was our last company. A couple of things as we wrap out and close here, heading into Benzinga Live later on at 11:30. We want to thank, of course, all of our companies that participate and give us a look into what they're doing. And, of course, our sponsor, Ticker. You can get involved with Ticker at ticker.com, TIICKER. You can get stock perks for the companies you're invested in and involved with and enjoy as brands. We're going to play their video, and we'll close it out for All Access.
Is Ticker. That's right, Ticker with 2 I's, just like you. Because it's for you, for investing, for stock perks, for connecting you to public companies who reward you as a shareholder, as a brand lover. That's why people can't stop tickering. Ticker, where investors discover shareholder perks and consumers become investors in the brands they love. Ticker. Start tickering today.
Wonderful. And that's going to do it for us here on a Friday, September 9th. Thank you again to all of our companies presenting. Thank you again to Ticker. Get involved at ticker.com. We will see you all on Benzinga Live, and we'll see you here on Benzinga All Access next week.